Okay, so let's dive into a pretty wild idea. What if everything we think about AI, all the incredible optimism, all the bullishness, is completely right, but what if that's actually a bad thing for the economy? I mean, what if it's bearish? That's the core question behind this really fascinating thought exercise from Saturni Research. They've imagined a financial history looking back from the year 2028. And just to be clear, this isn't some crystal ball prediction. It's more of a scenario, a way to explore some risks that, honestly, nobody's really talking about.
So here's the twist. We're not starting in the present. We're jumping forward in time, landing smack in the middle of a full-blown economic crisis. The memo we're about to unpack is dated June 30th, 2028, and it's basically a post-mortem, an autopsy report on how everything went so wrong.
So just imagine this scene. The S&P 500, it's completely cratered, down 38% from its peak just 2 years before. And unemployment, it's just shot past 10%. It's wild because it took only 24 months for things to go from what everyone called contained sector-specific issues to a total meltdown that nobody was ready for. And this is where things get really weird, right? This is the central paradox of the whole thing. See, in every single way, AI wasn't just working, it was crushing it, exceeding every expectation. Productivity was through the roof. So, how? How could this massive success story be the thing that caused total economic ruin?
Well, the problem, as the pundits of 2028 started to call it, was something called ghost GDP. Okay, think about it like this. A massive GPU cluster out in North Dakota might generate the same economic output as, say, 10,000 white-collar workers in Manhattan. And on paper, in the national accounts, it all looks the same. But here's the huge problem. Those machines, they don't buy coffee, they don't take vacations, they don't buy cars, so that economic output never actually circulates back into the real human economy. The velocity of money just stops.
All right, so let's rewind the clock a bit. Let's go back and see how this whole thing started. We've got to look at the very first domino to fall, the software industry, and how its supposedly unbreakable moat just, poof, vanished. You know, we all know the classic disruption story, right? Think Blockbuster versus Netflix. The old guard resists the new tech and just slowly withers away. But this time, it was totally different. The companies that were most threatened by AI, they didn't fight it. They literally couldn't afford to. So instead, they became its biggest fans, its most aggressive adopters. And that had this bizarre, almost suicidal effect of speeding up their own demise. And there was this one moment, a single earnings report, when the market finally woke up and saw what was happening. It was ServiceNow's Q3 2026 report. That report was absolutely pivotal because it laid bare this vicious, self-feeding cycle that honestly nobody saw coming. Okay, so here's the critical part. Just follow the logic. ServiceNow's customers start using AI to lay off their own workers. Well, fewer workers means they need fewer ServiceNow licenses, right? So they cancel them. Boom, ServiceNow's revenue gets hammered. So what does ServiceNow do in response? It lays off its own employees, and then, get this, it uses the money it saved to invest even more in the exact same AI technology that's wrecking its business. It's wild. Every company was making what seemed like a rational choice to survive, but when you added it all up, the collective result was just a total catastrophe. Okay, so you can probably guess that this didn't just stay a software problem for long. This disruption started to spread, and it spread like wildfire to any business really, whose whole model was built on monetizing friction, basically making money off the fact that humans find things annoying to do. I mean, think about it. Trillions, literally trillions of dollars in company valuations were built on one simple idea: that we humans get lazy, we run out of patience, and will accept a not-so-great price just to avoid a few more clicks. Well, AI agents just blew that entire model to smithereens. They started reshopping your insurance policies every single year automatically. They booked travel way cheaper than any human could. They even crushed real estate commissions from that standard 5 or 6% all the way down to under 1%. And this is a perfect example of what the memo calls the death of habitual intermediation. Just think about a company like DoorDash. Their entire business, their moat, is built on the fact that you're hungry, you're feeling a little lazy, and hey, their app is right there on your phone's home screen. But an AI agent, it doesn't have a home screen. It has no brand loyalty. It instantly checks DoorDash, Uber Eats, and a dozen other services to find the absolute cheapest fee and the quickest delivery every single time. For a machine, that concept of brand loyalty is just zero. From there, the disruption hit the very plumbing of the financial system. Once these AI agents were handling all our transactions, they started looking for the biggest, most inefficient fee they could eliminate. And the most obvious target? That 2 to 3% interchange fee that credit card companies charge on every swipe. The agents just started routing payments through cheaper channels, like stablecoins. And all of a sudden, the entire business model of giants like MasterCard and Visa was under a full-on assault. So you've got software, you've got all these middleman businesses, you've got the payment networks. All these separate threads started weaving together into this central engine of the crisis. And what it created was a terrifyingly efficient negative feedback loop, one that had absolutely no natural break.
They ended up calling it the intelligence displacement spiral, and it's exactly what it sounds like. A self-feeding cycle where AI-driven layoffs lead to less consumer spending. That, in turn, squeezes company profits, which forces them to adopt even more AI to cut costs, which, of course, leads to, yep, you guessed it, even more layoffs. And you can see the cycle laid out really clearly here. It all starts with AI just getting better and better. That leads directly to layoffs as companies try to cut costs. Then all those displaced workers, and even the ones who are just worried about their jobs, they spend less money. That creates huge margin pressure on companies. And what's their only logical response? Well, it's to invest more in AI to cut costs even further. And that just throws us right back to the beginning of the spiral, only this time it's spinning even faster. So as this spiral was spinning faster and faster in the real economy, the problem started to metastasize. It jumped into the financial system, creating these two powerful accelerants that took what was a sector problem and turned it into a full-blown systemic crisis. The first accelerant? The private credit market. Now, this market had ballooned to over $2.5 trillion. And a huge chunk of that money was tied up in these big leveraged buyouts of, you guessed it, the exact same software companies whose business models were currently getting vaporized. And the Zendesk default, that was the smoking gun. This huge loan had been written based on one core assumption, that its annual recurring revenue, or ARR, would actually, recur. But as AI automated away all the customer service jobs, that revenue just vanished. ARR didn't mean annual recurring revenue anymore. It meant revenue that just hasn't left yet. But honestly, as big as the private credit problem was, the second risk was on a whole different level. We're talking about the entire $13 trillion US mortgage market. See, that whole market was built on one single fundamental assumption, that white-collar workers would have stable, growing paychecks for the next 30 years. And suddenly, that assumption was getting completely blown apart. And then the really scary data started to roll in. Home values in tech hubs like San Francisco and Austin were dropping by double digits. But what was even more terrifying was that Fannie Mae started flagging a rise in delinquencies among so-called bulletproof prime borrowers. We're talking people with 780 credit scores in those very same zip codes. These were the people who are never supposed to default, but the world they got their mortgage in was not the world they were living in now. Okay, so after walking through that whole pretty dystopian scenario, let's pull back and bring it all back to today. The real issue here, the thing this whole scenario is about, is the unwinding of this premium that we've always placed on scarce human intelligence. For the first time, this thought exercise imagines a future where our most productive asset, technology, was actually a net job destroyer, not a job creator. But listen, this next part is the most important takeaway of this entire explainer. We've just walked through a really bleak future history, right? But you are not in June 2028. You are reading this in our present, right now. Those negative feedback loops, that intelligence displacement spiral, none of that has actually started yet. So remember, this isn't a prediction of what will happen. It's a warning shot. It's a fire alarm. It's a thought exercise designed to make us think about these things while we still have time to do something about it. The canary in the coal mine is still alive. And ultimately, it all boils down to this one simple fact. Our entire economy, everything from the job market to the mortgage market, even the tax code, was built for a world where human intelligence was the rare, valuable thing. That fundamental assumption is now breaking down. Machine intelligence is becoming cheap and abundant. So the only real question that matters is this. Can we build the new frameworks our economy is going to need before it's too late?